Consumption is the flow of households' spending of goods and services which into the utility of the current period. The marginal propensity to consume, which means to say that for every extra income, what is the consumer trying to go forward in terms of the consumption factor? Savings becomes a very important part as we are able to see that excess money when you have after all your expenditure is being done, that would become an add-on factor to you. Good morning and welcome to the revision session in the second PUC Macroeconomics. We're going to talk about Chapter 10, Consumption and Investment Theory. Now, what we have got today is on the chapter introduction, the weightage, question types, questions and answers. Now, this chapter is very important, and you would see that we have a weightage of 2 1-mark questions, 2 2-mark questions, so that's about 4 marks, and 1 4-mark question. So the total weightage that you can see here is worth about 10 marks. So you have a 10 marks coming up from this chapter. Though this chapter might slightly look difficult to you in terms of understanding, but it's a very easy chapter if you focus on the key points. Let's move further. So first, let's try to understand the meaning of consumption. Consumption is the flow of households' spending of goods and services which into the utility of the current period. So at any given point of time, whenever you want to understand the meaning of consumption, that means to say that what is the households are trying to do in terms of their income, in terms of the factor. Saving is that part of the disposable income which is not being spent. Investment is the firm spending on goods which are not on the current consumption, but they yield a flow of consumer goods and services in the future. So that's what we are going to talk about in terms of the investment factor. Now, moving further, we're going to talk about aggregate supply of income, which is going to, the aggregate supply of final goods, where we're going to talk about what is the final level that of the goods that are being supplied in the market, the aggregate demand for final goods, how much is that, the marginal propensity to consume, which means to say that for every extra income, what is the consumer trying to go forward in terms of the consumption factor. We're also going to talk about aggregate demand. The aggregate demand is a very important concept. Why? Because when you look into the markets today, many a time it becomes very relevant for all of us to understand the psychological factor. How much is a consumer trying to consume based on the income, based on a savings factor, and on the investment factors. So the multiplier process also tries to coincide with these 3 things, where it tries to tell you how much is the consumption, demand, and the aggregation that we need to maintain, that we need to take upon altogether. Now let's come to the examination corner, trying to understand the 1 marker. Write the meaning of consumption. Consumption refers to the goods and services to attain desired satisfaction, which is very important. Let's understand. Refers to the use of goods and services to attain desired satisfaction, which is a very important factor that we are speaking about, followed by what do you mean by savings? Savings refers to the excess income over expenditure. Now that's the excess factor. Whenever we say that, let's say that you're going to earn 100 rupees and you're going to save 50 rupees out of it. So this 50 rupees becomes your savings. Now what happens is that, suppose even after all the expenditure, you are able to save some sort of money. That's where savings becomes a very important part altogether. Savings becomes a very important part as we are able to see that excess money when you have after all your expenditure is being done, that would become an add-on factor to you. Followed by define investment. James Keynes told that investment refers to the addition of the nation's physical stock in terms of capital goods like roads, bridges, buildings, machineries, etc. So what are we looking here is that we are looking in for an investment factor in terms of capital like roads, bridges, buildings, machineries, all those factors which are adding up to the growth factor altogether. Now that is very, very important for all of us to understand here. Why? Because this is actually adding up in terms of your physical investment. Marginal propensity to consume, a very, very important topic which refers to the change in consumption to the change in income. So as your income changes, there will be a change in the consumption pattern also. So that is very, very important for all of us to know. Why? Because the marginal propensity also tells this factor very clearly, that it is actually making you understand about if the income keeps on increasing, it is not mandatory that your consumption will also keep on increasing, but definitely there will be a change in the pattern of your lifestyle. So over a long time period, you would see that income actually plays a very great role when we are talking about the consumption pattern. Followed by the meaning of multiplier. What is multiplier? It is the ratio of total change in income to the initial change in investment. It expresses the quantitative relationship and increase in income and increase in investment factor. And this is very, very important. Why? Because this will actually make you understand how we are talking about the investment pattern, that is the relationship between that of income and investment pattern coming into picture. Sometimes we find that the initial change in the relationship of that of the investment brings in a great amount of change factor altogether. The next one, as per J.M. Keynes, what we see that the income is actually received by four factors. What are those four factors? Rent, wages, interest, and profit. So whenever we talk about income, it is not just one factor, but it is a multiple factor. So those factors where we see as your consumption factor, when we start looking into the investment, Y as an income, C as the consumption, and on the expenditure, we see that these are all the factors of income that come together. The next one is, how is savings equal to that of investment? We see that every saving that is being made by the consumer can be utilized in terms of an investment factor also. So what happens is that once the consumer starts believing that the amount of money that I have saved, if I start investing it somewhere, and if is able to gain a greater rate of interest, so automatically savings will start getting into the investment cycle. As the investment increases, the savings starts coming down, and vice versa. If the savings increases, then the investment part will come down for a consumer. Followed by, what are the four types of private investments that we are talking about? We can look into the private investment, and we can look into induced investment and autonomous. Induced investment is something where you've been forced, or you take a step or a plan to invest money, like let's say mutual funds, or you're going to invest in equities like that. That's what we call it as an induced investment factor. And autonomous is where it happens by itself. Then we're going to talk about ex ante and the ex post investment. Ex ante is planned, ex post is the unplanned investment. Gross and the net investment. So many a time we would be looking into factors where we are trying to actually concentrate upon the ex ante investment, because many a time we go with a planned investment, but there are sometimes it just comes in between where you just want to make the payment, where you want to make the investment, so you go with the ex post investment altogether. We also have the gross investment and net investment. The gross investment is actually what we see as an overall investment, but after subtraction of taxes and other factors, you will come to know that what is the net investment that lies in our hands. Followed by the 4-mark questions, where we're going to come about the Keynes function again in terms of investment. Now this is mainly where we're talking about shares, stocks, bonds, and securities that are existing in the market. According to J.M. Keynes, if you start understanding and analyzing, the real investment which adds to the capital stock is what matters. It leads to increase in the level of income and production by increasing the production, purchase of capital goods. Yes, that's what happens altogether. But then how does the investment come into picture? It primarily comes into picture by the factor that yes, there is amount of growth factor, there is an amount of productional factor that comes into picture through which you would be able to see that there is an increment in terms of the goods. Now, investment is also production of acquisition of real capital assets by during any period of time. So capital and investment are related to each other through the net investment. That's a very important factor. And the other income from the community increases when the consumption also increases. But it does not increase at the same proportion. So you cannot say that consumption and income will always increase at the same level. Now, what happens here is that there is always a gap between consumption and income. The gap must be filled by the increasing employment and production need. That's where investment comes into picture. Many times what happens is that we'll start feeling that though we are getting an increased income, but then I don't want to spend all the money. I want to go on a saving mode. I want to see that whether I can retain the money for a longer time period. I can start holding the money for a longer time period. So what I do here is that I try to hold back the income. But what Keynes feels is that if the economy has to move, there has to be a cyclical function of investment that has to be bought inside, and then only the economy will start stepping up. So that's the reason most of the time you get suggestions from many of the financial planners that whoever has got excess income or excess saving, they need to start stepping up into investments through which they would be able to increase up the economic progress. Now, the concept of saving and equality, this is one probable question in 6 mark, but nevertheless, we'll just have a look into it. The saving and that of investment function that we're going to talk about. Consumption function is also called as propensity to consume, which refers to income consumption. Now, we're going to refer it in a very, very simple equation. C is equal to function of Y, which is function of income. So C is the consumption, Y is the income, and F is the functional relationship that we are talking about. Now, in fact, consumption is a schedule of various amounts of consumption expenditure corresponding to the different levels of income. So consumption directly is related to income somewhere. Only thing is the level of income that comes into it. Now, what is an investment function? That involves buying of shares, bonds, securities, and market. So according to which there is an increase in your capital stock altogether. So when you look into this functionality, there are many factors that lead into the relationship between the consumption and that of the income factor also. Now, when investment is a production and acquisition of the real capital assets, whereas these are the capital and investment are related through various other factors. Now, consumption is also increasing with the income, but it does not increase proportional, as I have told you. And there's always a gap. This gap can be filled only when we step in various factors of investments inside. Now, the decision to invest in a new capital asset will always determine based on the return that you're going to get from that asset. And this is what we will look into it. And this is what we will be looking in terms of purchasing the new capital asset coming into picture. So whenever we are going to make any investment, whenever we are going to make any decisions regarding that of investment, we will start thinking twice whether are we going to get a good rate of return? Are we going to get a good rate in terms of buying in and buying out? Then only we will start putting funds into it. If the asset is not going to give us a greater rate of return, then we might not find this as a good value of investment. Only where there is a higher rate of investment, the asset would be put into investment and we would try to start seeing a better rate altogether. With this, I come to the end of this particular chapter. I hope and believe that all the points that have been discussed through this particular session will be of great help to you, both from the exam standpoint of view, also in the practical stand. In the upcoming sessions, we will be talking about the chapter 11, where we are going to talk about the consumer budget, and we are also going to talk about the government budget and expenditure, which is a very, very important topic there. Until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this wonderful session.